Have you ever wondered if a student loan could reduce your Social Security or SSI benefits? A viewer recently asked, "What about student loans?" And that's a great question because a lot of people on SSI, SSDI, and even early retirement are trying to go back to school or help their children with education costs. But the rules are confusing, and one small misunderstanding can cause unnecessary fear or even benefit suspension. So today, we're going to break it all down: how SSA treats student loans, grants, and refunds, what counts as income or resources, and what's completely safe. I'll also show you how to save or spend education funds the right way to avoid problems later. If you find this helpful, please like this video, subscribe to Social Security Post, and tell me your city and state in the comments. And if you have a question about your own situation, like student loan refunds, disability discharges, or Pell Grants, drop it below. I personally read every comment and may feature your question in a future episode. Let's start with the basics. Social Security only counts money as income if it increases your assets permanently, meaning you don't have to pay it back. A loan, by definition, doesn't meet that standard. It's money you're borrowing, and you're legally obligated to repay it. So under SSA policy, a bona fide loan is not counted as income, whether it's from a bank, a school, or a federal education program. For a loan to be considered bona fide, SSA looks for three things. It must be legally enforceable under state law, made in good faith, and you must have a clear intention to repay. Federal student loans, private student loans, and even school-based loans all meet that test automatically because you sign a legal repayment agreement before receiving the funds. That means your student loan does not reduce your SSI, SSDI, or retirement benefits. Here's where most people get confused. SSI is needs-based. It has strict limits on how much you can own. In 2025, the resource limit is still $2,000 for individuals and $3,000 for couples. SSA checks your bank balance at the start of each month to make sure you're under that cap. SSDI and Social Security retirement benefits are different. They're insurance programs, not welfare. They're based on your work history and earnings record. That means there's no limit on savings, assets, or resources. If you're receiving SSDI or retirement benefits, you can have student loans, bank savings, or even investments, and SSA won't touch your check. The only time income rules matter for those programs is if you're still working and earning wages above the substantial gainful activity limit for SSDI or the earnings test before full retirement age for retirees. Now, what happens when your student loan money is actually deposited into your account? SSA doesn't count it as income, but for SSI, it temporarily increases your resource total. Let's say you receive a $4,000 disbursement from your school. That money isn't income, but it's still cash sitting in your account. If it's still there when the next month begins, at 12:01 a.m. on the 1st, it becomes part of your resources. If your total across all accounts goes over $2,000, SSA can suspend SSI until your balance drops back below the limit. That's why timing matters. Spend those loan funds on education-related expenses, tuition, fees, books, transportation, technology, before the next month begins. Keep your receipts to prove where the money went, in case SSA ever reviews your account under programs like AFI, Access to Financial Institutions, or EM 25046, which are now active nationwide. Most colleges disperse financial aid in 2 steps. They pay tuition first, then send you a refund for the leftover amount. That refund is still part of your loan, not new income. But again, under SSI rules, if that refund sits unspent past month end, it becomes a resource. Example, you get a $1,200 student loan refund on April 25th. If $800 of it is still in your account on May 1st, SSA will count that $800 toward your resource limit. The best approach is to plan your spending schedule. Use loan refunds quickly and directly for educational or disability-related expenses. This keeps your balance below the resource cap and shows SSA that you're using funds for legitimate purposes. You're not penalized for borrowing. You're only penalized for letting balances accumulate. Here's where many students get tripped up. Loans must be repaid, so they're not income. But grants, scholarships, and work-study earnings are treated differently. Some education funds, especially Title IV federal student aid, like Pell Grants, FSEOG, and federal work-study, are excluded from SSY if used for tuition, books, fees, or other educational expenses. However, if you use grant money for food or shelter, SSA considers that in-kind support and maintenance ISM and can reduce your SSI check for that month. The reduction is limited to the presumed maximum value, PMV, about $334 per month in 2025. So, using a Pell Grant for housing could lower SSI slightly, but spending it on education items won't affect your benefits at all. For people on SSI who became disabled before age 26, there's a great option called an ABLE account, short for Achieving a Better Life Experience. You can deposit up to $17,000 per year into an ABLE account, and SSA will not count up to $100,000 of those funds toward your SSI resource limit. That means if you receive a student loan refund or gift for education, you can move it into your ABLE account and use it later for school, transportation, medical devices, or housing without endangering your SSI. ABLE accounts are one of the most powerful tools SSI recipients have to safely save for education or future expenses while staying fully compliant with SSA rules. If you receive SSDI, you can rest easy. Student loans, whether federal or private, have zero impact on your benefits. SSDI doesn't track your savings or loan balances. It only looks at your earned income from work. In fact, if you've been found disabled by SSA and receive SSDI, you may qualify for total and permanent disability TPD discharge of your federal student loans. This means your federal loans can be completely forgiven through the U.S. Department of Education. SSA and the Department of Education share data, so if your disability review shows you're permanently disabled, your loan servicer can automatically start the TPD process. You'll never lose SSDI for using it, and it removes future financial pressure. If you fall behind on student loan payments, federal law allows the Department of Education to garnish up to 15% of your Social Security or SSDI benefits to repay defaulted federal loans. But don't panic. There are strict protections. The government must leave you with at least $1,203 per month as of 2025 after any garnishment, and SSI benefits are completely protected by law. They cannot be garnished for student loans. The best way to avoid this situation is to contact your loan servicer right away and apply for an income-driven repayment plan or a hardship deferment. SSDI and low-income borrowers often qualify for $0 payments, which stops interest buildup and prevents garnishment entirely. Let's look at a few examples that explain how SSA views this in practice. Example 1. A student on SSI gets a $3,000 loan, spends $2,700 on tuition and books, and has $300 left on the first of the next month. That $300 counts as a resource, but it's still under the $2,000 limit, so no issue. Example 2. A disabled SSDI recipient borrows $5,000 in private student loans. That's not income and doesn't affect their benefit. SSDI doesn't track resources. Example 3. A borrower on SSDI qualifies for TPD discharge of $20,000 in student loans after SSA confirmed permanent disability. Their SSDI remains unchanged, and the canceled debt is not treated as income for SSA purposes. Here's how to keep things clean and safe. Keep your loan agreements, award letters, and school refund records. Spend or transfer education funds before month end if you're on SSI. If you have leftover refund money, consider using an ABLE account to store it safely. For SSDI or retirement benefits, student loans have no effect. Just watch for loan forgiveness or tax implications. Always label accounts and transactions clearly if SSA ever asks for documentation. Remember, student loans are there to help you advance your education and independence, not to penalize you. SSA's rules can seem strict, but once you understand the logic, they're entirely manageable. Student loans can sound intimidating, but as you can see, they don't hurt your Social Security or SSI benefits when handled correctly. They're not counted as income, and the only time you need to watch balances is if you're on SSI and close to the resource limit. Keep your paperwork, spend smart, and always track what's in your account before the first of the month. If you have a question about your own situation, like a loan refund, an ABLE account, or how SSA views your balance, write it in the comments. I reply personally and may include your question in the next video. Please like this video, subscribe to Social Security Post, and share it with anyone you know who's trying to study or return to school while receiving benefits. See you in the next video.